What if I told you your future tax bill just got rewritten, with no warning, and that your investment profits might be taxed differently without you even realizing it? Picture yourself stepping off the metro in Madrid, scrolling through your phone, and reading about dramatic shifts in US tax law that ripple all the way to your portfolio. That's exactly what's happening now. The IRS has released the 2026 tax brackets and a fresh capital gains update, and the consequences? They're real. Whether you're Luca in Milan juggling freelancing and investing, Sophie in Berlin mapping her early retirement, or Alex in London managing cross-border income, these changes matter. Stick with me, because by the end, you'll know exactly where you stand and how to turn this into your advantage. Let's start with the simplest truth. In finance, everything is connected. Even though these are US federal tax rules, they send shockwaves into global capital markets, corporate strategy, and cross-border investing flows. You might think, I live in Europe, I don't pay US tax, but if you ever hold US stocks, ETFs, crypto, or interact with American markets, these updates could influence what you pay, when, and how you strategize. And more than that, watching how the US tax system shifts gives a window into how governments respond to inflation, fiscal pressure, and investment trends. You don't just want to react, you want to preempt. So yes, this is relevant. Let's walk through what's changing and then how you can act. The IRS has officially published the adjusted tax brackets for 2026. These adjustments reflect inflation and recent legislation meant to soften the blow of bracket creep. The 7 core marginal tax rates remain unchanged: 10%, 12%, 22%, 24%, 32%, 35%, 37%. What moves are the income thresholds for each bracket. They've been nudged upward by roughly 2% to 2.3% to reflect inflation. Here are a couple of reference points. For single filers, the 10% bracket now covers income up to $12,400. The top rate, 37%, begins at $640,600 for singles. For married couples filing jointly, 37% starts at $768,700. So unless your income grows faster than inflation, you shouldn't slide into a higher bracket just because of price rises. One of the most helpful updates is in the standard deduction. It's going up across the board. Single married filing separately, $16,100. Married filing jointly, $32,200. Head of household, $24,150. If you're 65 or older, there's an extra boost. For 2026, a bonus deduction of $6,000 for seniors is now available whether you itemize or use the standard deduction. Additional incremental amounts for being blind or over 65 also adjust upward. These extra deductions are not trivial, they give you more buffer before income becomes taxable. Other notable tweaks include the estate tax exclusion being bumped higher, meaning more of your legacy can pass tax-free. The SALT deduction cap rising to $40,000 for joint filers. And credits like childcare, adoption, and family benefits being expanded or inflation-adjusted. These are not footnotes, they change the contours of what's possible in your tax planning. If you've ever bought and sold investments, stocks, crypto, property, capital gains tax is your hidden companion. The 2026 update doesn't rewrite everything, but mixes in important directional shifts. Let's unpack. Short-term gains, assets held less than or equal to 1 year, are taxed as ordinary income, i.e., under the same brackets discussed above. Long-term gains, held greater than 1 year, enjoy preferential rates, 0%, 15%, or 20%, depending on your income bracket. These favorable long-term rates continue to exist. However, the income thresholds for those long-term brackets are being adjusted upward, giving more breathing space. For example, in the 2026 model, the zero-rate capital gain threshold for single filers edges closer to $49,450. The 15% bracket ceiling shifts accordingly, so more gains may be taxed at lower rates than before. Also, don't forget the net investment income tax. For high earners, there's a 3.8% surtax on certain investment income if your adjusted gross income surpasses a threshold. Under prior tax law, capital gains brackets were separated from ordinary income brackets for high earners. But when many individual tax provisions sunset at the end of 2025, that separation may vanish. If that happens, long-term gains would be more firmly tied to your ordinary income bracket, meaning any bump in your salary could indirectly pull up your capital gains rate too. This is a change you don't want to be surprised by. When numbers are cold, stories bring them alive. Let me share 3 snapshots, European settings, real decisions where these changes matter. Sophie in Berlin is a digital artist. In 2025, she sold an NFT and realized a solid gain. But she panicked, if I sell now, I might hit a higher bracket. Thanks to the shifting capital gains thresholds, 2026 might give her more cushion, meaning she can choose when to sell rather than being forced by fear. She's now planning to wait a few months, line up other income, and see if her total taxable income stays low enough so her NFT gains land in a 0% or 15% capital gain zone. Luca in Milan runs a small tech consultancy. In 2025, one big contract pushed him just over his comfortable bracket. It stung, he felt less rich, but it was mostly bracket creep. With the 2026 bracket shifts, that same extra income might not push him upward. He's rewriting his pricing strategy. He might now accept a bit more income with less downside. Alex in London works remotely for a US firm. Part of his income is in dollars, other in euros. He wonders, will I ever owe US taxes on part of this? How do these shifts affect me? Now, he maps scenarios. If he ever holds US equities, or receives US-sourced income, he can estimate how much buffer these bracket changes give him. He's not waiting for tax time, he's planning ahead. Numbers without action are just noise. Let's turn knowledge into strategy. Below is your 2026 tax game plan. Create income projections. What happens if your salary or investment gains rise by 5%, 10%, 15%? Which bracket do you land in? Compare itemizing versus standard deduction. With bigger deductions, sometimes itemizing isn't worth it. Hold investments beyond 12 months whenever possible. The switch from short-term to long-term can save you significantly. Use tax loss harvesting strategically. Sell losers to offset gains, but respect wash sale rules. Time large capital events. If you're planning a property sale or business exit, decide which tax year to place it in. Monitor whether the TCJA sunsets. If the decoupling of capital gains ends, act faster. And finally, remember to factor in currency movement. Exchange rate swings can shift your tax outcome across borders. You might hear all this and feel it's too late to reposition. It's not. Many of the power plays here are still under your control. You can still choose when to sell an asset. You can still structure your income mix. You can revisit your investment allocation. You can stay alert to legislative changes. Knowledge gives you optionality. Even if the law is fixed, your choices remain yours. Here's a truth behind the curtain. Governments adjust tax codes when inflation rises and debt piles up. Bracket shifts, deduction tweaks, capital gains changes, they're all tools to balance the books. But for you, these shifts are signals. If you're reacting, you're behind. If you're watching, anticipating, modeling, you're ahead. These 2026 changes are part of a larger rhythm, the balance between growth and taxation, between freedom and obligation. Learn the rhythm, and you'll dance with the system instead of tripping over it. Let me leave you with this. Financial independence isn't built on luck, it's built on awareness and small, consistent choices. These tax law changes won't define your wealth, how you respond to them will. You don't need to transform overnight. You just need to move closer to being one step ahead. Let these 2026 updates sharpen your curiosity. Let them push you to plan not with fear, but with purpose. If you take one action today, let it be this. Open a planning sheet, plug in your income, simulate the new thresholds, and see where you land. That single insight will spark better decisions. When you're ready, revisit this again during planning season and share it with a friend. Because the future of your finances is built one informed decision at a time. You've got this.
This journey is built on strategy, consistency, and value. If my content helps you grow financially, there's a PayPal link in the description. It's not about the amount, it's the support that counts. Every bit fuels more value. Let's build wealth together.